Hi, my name is Lisa. I'm also an undergrad here. And I noticed that one of your investing principles is that to invest in high uncertainty companies. And notice that in markets, people often interpret high uncertainty as high risk. I'm just wondering how would you differentiate or how would you interpret the idea of high uncertainty and high risk?
Sure. Well, that's a good question. So, risk and uncertainty are two different things, and markets many times get confused between the two things. So for example, if I were to let's say look at a funeral services company, company focused on either cremating or burying the dead, and let's say they're in certain geographies. Uh, we don't know who's going to die in Peoria, Illinois next year, but we know how many are going to die. Okay? So if you want a predictable business, there is probably no more predictable business than a funeral services business in Peoria. Okay? I can tell you 10 years from now what their cash flows are going to be, even 20 years from now what their cash flows are going to be. Right? So a business like that exhibits no uncertainty. Right? It's a very low uncertainty business. And generally speaking, businesses with low uncertainty tend to be fully priced. They almost become like bonds, because if you have a real estate investment trust, it has a set of Class A properties in prime locations, 95% leased. The economy is doing well. You can see those cash flows for a while, and it's got a lot of stability to them. On the other hand, there are businesses which by their very nature are subject to very high uncertainty. So for example, let's say they were an oil company, right, where the revenues and cash flows are very dependent on the price of oil. They haven't hedged anything. Or let's say they're the shipping company, which has got its entire fleet on daily charters, if you will. And again, in some cases, those charters can vary so much that you can get very high deltas in what the cash flows can be. So one of the cues in investing is that one should look for situations where you get the combination of the two, where you get a combination of very low risk and very high uncertainty. So when you see an example of the two together, the odds are very high that you can make a lot of money. So I'll give you an example. I think this was in 2000. In 2001, there was a company I invested in. It was called Frontline. It was a shipping company, and what they did is they transported crude oil. So they had these VLCCs, very large crude carriers, which are transporting oil between, let's say, Saudi Arabia and the US and so on. And these crude carriers are huge ships. At that time they cost about $70–80 million a piece. And there are two ways that people use these ships. They either do leases, kind of time charters, or they're on the spot market. So in the case of Frontline, they had something like 40% of the global fleet of VLCCs, and they were all on the spot market. So on the spot market, VLCC's range of daily rates varies from something like $10,000 a day to $250,000 a day. It's a huge variance. And break-even price for these ships was at that time about there to make at least 20 or 25,000 a day to break even. So what had happened in 2001, I think 2001, 2002, when I was looking at Frontline, is there was a glut of ships, too many ships, and not enough crude being shipped around. And so as a result, shipping rates had collapsed. And at that time, shipping rates were around 10 or 12,000 a day. So Frontline's fleet was losing money. And the stock price went down to something like $3 a share. So these ships also have an active market of being bought and sold. So I could look in, for example, Clarkson's was a publication. I could look at what the distressed selling price of these ships was at that time. And if the entire company just sold everything at a distressed price, they would get something like $11 a share. So it was trading at, huge 60-70% discount to liquidation value, mainly because there was fear, right? I mean, this is like there's kind of the midnight of the oil shipping business, if you will. And now the other nuance, we talked about mental models. Since we have some time, I'll just make this a little bit more detailed. There's a friend of mine who is in the real estate business, and he was telling me that Class A office towers in major urban areas normally take 3 to 5 years from the time someone thinks about them to the time they're ready. It takes a long time. And usually what happens in the real estate business is that when occupancy gets really high and vacancies are very low in these Class A towers, everyone and their brother plans to build them. But the thing is, it takes 3 to 5 years to build it. By the time they get built, they all hit the market at the same time, and then everything collapses. So in these real estate towers, you have this boom and bust cycle going on, because they're like lemmings. When everything's jamming, everyone and their brother is building, and they all come on the market at the same time. The VLCCs are very similar in the sense that it takes a couple of years, 2 years, 3 years to get a VLCC built in a Korean shipyard. And usually when the rates are really high, 80,000, 100,000 a day, everyone and their brother places orders. And what happens is that on a $70 million VLCC, you can place an order by giving them $2 million or $1 million. You don't have to put up a lot of money. It's like ordering a Model 3. $1,000 gets you the Model 3. And so on the other side, when rates go to 10,000, nobody wants to place orders. There are no orders being placed, just like there are no towers being built. And so what happened in the VLCC market is when these rates go to like 10,000, scrapping increases, because they can scrap the ships, the old ships, and get a lot of instant cash from the steel value. So what happens in the VLCC market is that when these ships, there's a glut of these ships, there's excessive scrapping taking place. But when those ships get scrapped and then the demand comes back up, you cannot instantly have more ships. And so the only thing that happens is the price changes. So I bought Frontline. I just wanted to capture the liquidation value spread. So I bought it at $3, $4. And it, eventually got up to, as the rate started going up, it got up to $8 or $9. It was still below liquidation value. I sold the stock. I think in 6 months I doubled my money or whatever else. But then the second part, which I missed, came to bear, which is there weren't enough ships. Rates went to $250,000. They're sitting there with 40 ships, and eventually the stock was at 200 to 1. So if I had been like Sanjay and I just put my 5,000 there and just gone away, that would have been the thing to do, and such. So so I think that was a case of very low risk and very high uncertainty because of those dynamics. And so if one is kind of a student of these things, you can find these kind of weird things in different industries, and it's a fun hunt when you find them, to look at them and such. So that's what I would suggest. Yeah, go ahead.